Every 3 months, I like to do an update on global markets and what's been happening, what that means for the typical investor. And this quarter, I'm going to cover some of the underlying questions which haven't yet been determined by the market and what that might mean for typical investors. If you like the content that we produce and you haven't yet subscribed, it'd be great if you did click on the flying colours icon and do that. I would really like it if you actually liked the video because it would help us to get more visibility on YouTube. Thank you. When I say questions that the market is trying to answer, I mean important issues that the market hasn't worked out exactly what the answer is quite yet. So I think that right now there are three big questions that the market is pondering. One, will there be a global recession? Secondly, have we broken the back of inflation or will it come back with a vengeance? And lastly, what do we make of the AI phenomenon? How much of it is hype and how much is real? So if we think of those questions, they're affecting most asset classes. So a recession would mean probably a fall in the value of equity markets and probably a rise in the value of government bonds. And in the last quarter, we've seen fears of a recession reduce, and many investors are now quite complacent about it. But I think that there is still a realistic chance that we do get a global recession. And so I don't think that question is quite answered yet. And I would suggest that people be careful about that. The second question about inflation is definitely unanswered, and there's a lot of uncertainty in the market. So we have seen inflation come down after the highs after the COVID experience, but we haven't seen them come down dramatically, and we haven't really hit, in terms of core inflation in Western markets, the target that people are looking for of 2 to 2.5%. So there is a real chance that inflation might reaccelerate. That would be negative for most asset classes. So it would be bad for bonds and probably bad for equities. So we hope that doesn't happen, but it is quite important, again, that people realize that it could happen, and you need to have some form of protection against that in the investments that you hold. The last thing is AI, which is really intriguing. And like everybody else, we've been looking at it and experimenting with it, and we like what we see. The question for us with AI is separating the technology from the investments. So my simple take on it is that all of the people who are currently developing AI are using the same methodology, which is large language models trained on pretty much on the same data, the World Wide Web, using very similar methodology to do this. So it's quite likely that they'll end up in similar places because they've gone about it in a similar way. So unlike other areas of technology where people really own something unique, and it's patented and it's differentiated and they can charge a real premium price for that, here, I think there's a real chance that AI will continue to develop and improve, but the competitors are so alike that the margins that you can make and the revenue you generate will disappoint. The companies are spending hundreds of billions of dollars a year building out the systems. So I think that there is a significant chance that there could be a disappointment. Now, saying there's a chance there will be and predicting there will be are two different things. But our preferred style of investment very much is to try and avoid areas where there is significant risk, because we don't think it aligns with what a typical retail client in the UK wants, which is a stable, predictable retirement income. Now, if we turn to our portfolios or portfolios in general, and we look at how we've been doing, our philosophy as an investment company is to try and make sure that we fully participate in long-term asset class returns so we can meet the objectives that people have in their portfolios, but we have protection in the portfolios against the risks that we see, and we avoid or significantly reduce our investment in areas where we see significant risk. So right now, we are still concerned that there could be a global recession. So we do hold money in bonds, which are making reasonable returns today, but of course they will come into their own if there is a recession. We are a little bit nervous about a reacceleration of inflation. So we have commodities exposure within the portfolio, as well as index-linked bonds. And we are not chasing very highly priced stock market investments, which would be most exposed if inflation does reaccelerate. So that is possible. We've got significant protection. And lastly, we're not really chasing the AI bubble, because whilst we're excited about it and we've experimented with it like many other people, we think there are lots of unanswered questions, and we don't like the market behavior, and we don't think it aligns with what our clients are looking for, which is stable returns that you can rely on in retirement. Because of the protection that we build in for things like inflation protection, recession risk protection, and the need for us to want to avoid areas of the market that we think are risky, like AI stocks, actually in the last quarter, we have slightly lagged the peers who are often positioned slightly differently to us. Now, we've had this situation many times before in the portfolios, and every time actually it's worked in our favor ultimately. But it can be a little bit uncomfortable in the short term. So we are perhaps 0.3 to 0.5% behind the peer group in the last quarter. So noticeable underperformance, but not yet dramatic or particularly worrisome. We're confident about how our portfolios are positioned, and we are pretty certain it's the right thing to do to align how we invest with the need that our clients have for stable, predictable income and returns that will meet their objectives. I've been talking about investing today, so I must remind you that your capital is at risk.